Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the Monday, the 10th of January, Bull versus Bear webinar here with Steve Miley on the call for TradeDay.com. So welcome everyone. We're going to go through our kind of usual run through here today. We'll take a look at the calendar, what we've had, what we've got coming up, particularly looking at a little quick recap of what happened with the unemployment and the employment data that we had come through from the US on Friday. We will go on to take a look at the calendar for the week. On Mondays, I tend to take a look at what I like to call the shape of the week, and we're going to run through the whole calendar for the week. Where are the major points that we should be watching for going into this week? And even though we're kind of focusing on day trading here at TradeDay.com, it's important to have an idea of what's coming up later in the week, because if we have a lot of data maybe or a lot of events towards the second half of the week, the latter part of the week, it'll likely mean that the beginning of the week should be potentially less volatile, and then you may then see your trading strategy kind of slightly tweaked and changed based on the fact that we're expecting less volatility. So you may look for a target not as far away if we're going to expect less volatility because we have a busy second half of the week, and you may then have a tighter stop. So it is important to take a look at the overall shape of the week. So we'll look at the calendar, Friday's data, what we've got coming up for the whole week, coming into this week, the major, not going through everything, just going through the major points. We'll take a look at some articles from the major news wires, just see what the major themes, and I'll run through those major themes, give you a brief summary of those major themes, and then we'll take a look at some charts and see how it's actually impacting the charts and where we could actually potentially see some ways of actually profiting from the events that are going on right now. So let's have a little recap first of all. So the employment report, always much watched. The employment report was mixed, to say the least. Very mixed, in that we had a big miss on the non-farm payroll data. So the expectation for December, according to investing.com, we had a range really. 400,000 investing.com, Bloomberg talking, I think it was 447 Bloomberg as their consensus. It was certainly in the 400s in most places. The data came in at 199 jobs added. So that's a big miss, not as many jobs added. And we spoke on Friday about that was potentially going to be a miss that actually would probably kind of counterintuitively maybe be positive for markets, because the markets are very concerned about inflationary pressures and a more hawkish Fed and a more hawkish central banks globally. And if we'd had a strong data number, a strong non-farm payroll number, then that would then point to an even more potentially hawkish tone from central banks, the Fed, and a more of a higher yield pressure on US and global yields, with the big move that we saw higher in global yields last week to begin 2022. And so a strong piece of data wouldn't necessarily have been good for, say, stocks for the overall outlook for the stock market. So we had a miss on that. So you could argue that was kind of in some ways positive for stocks. But then on the unemployment rate, we were expecting to come in at 4.1%. It came in at 3.9%, super low unemployment rate. Getting very close to, if not hitting, the Fed's expectation of what the natural unemployment rate is for the US. Given that, that kind of mixed result had kind of mixed outcomes, in that markets didn't really move a lot, even though we had a big miss on one and a big win and a big kind of beat on the other one. That kind of in some ways cancelled each other out a little bit in here. So markets were a little bit indecisive about what to do. Stock markets tried to initially rebound and then finished up. The major stock averages finished it up the week actually down on the lows, having had a significant sell-off earlier in the week because of the moves higher in yields and because of the moves that we saw after the Fed minutes last week, which certainly signaled and indicated a more hawkish Fed. So if we go and take a look at, say, the NASDAQ in here, I'll go take a look at the daily chart. The NASDAQ particularly hit, remember we spoke about this, NASDAQ is full of growth stocks, tech sector, growth stocks, and growth stocks particularly hit by moves to higher yields, lower bond prices, higher bond yields. So the NASDAQ, we did get a rebound effort in here on Friday, but then sold off, and then lower again in here this morning. It did have another little rebound attempt this morning on the overnight, on the futures contract here. But look, you can see now we've actually undercut this low. That was from just before Christmas, and also this low in here, which was from the beginning of December. undercutting these lows, and that sets up a potential for a big double top in here. So that would point to a far more significant sell-off in here. But really, we're going to have to wait to see what actually happens after the US equity market, cash market open, and then also wait to see what happens after the. So actually, I'll just pop this out a little bigger. See what happens in here. Not only at the cash market open, but also see how we end up. If we can close back above this low in here from the 20th of December, then things not looking as bad. So it's got the closing price today is going to be important. If it closes down below this low, then it all looks very negative going into the balance of this week. And you can see in here we go into a 30-minute chart. The market did try to rebound on a number of occasions last week, ended up lower at the end of last week down here, and then lower again in here this morning. And not quite as negative, but still nevertheless negative in here. Here's the S&P 500. So again, the S&P 500 tried to rebound on Friday, failed, went down, made a new low, and then lower again in here today. So not as negative here for the S&P 500, but nevertheless still negative. And the primary driver of this was this in here. So yields continuing to go lower. We saw all last week. We saw a very negative start to the week in here. And this is all to do with concerns around building inflationary pressures, not just in the US, but globally. So, this is not from the Fed minutes only. This was from the kickoff of the year, from the first trading day of the year, 3rd of January. Last Monday, the market accelerated lower in price. Remember, this is the March futures contract on the 10-year note. Lower in price equals higher in yield. So lower in price. And then another acceleration on Wednesday. That was after those Fed minutes. And then Thursday, we broke down through the low. And then Friday, lower again. And then you see this morning, we've actually have gone lower, but then a decent rebound in here. Higher prices, lower yield. So we're only just going back to where we kind of ended the week on Friday. But the market has probed lower and rebounded. So this is interesting already. Maybe the bond market is saying we're done to the downside for now, and if we can get a rebound back higher, a corrective rebound. And now if you look in here, we've had 5 straight down days last week to start off 2022 for the bond market. If we get a rebound in here today, that could ease pressures on the downside pressures that we're seeing, and just flicking back in here here's the equity markets. There's the S&P and here's the Nasdaq on the 30-minute charts. They're still pointing lower, but that could ease some of the downside pressures if we get a rebound. And if I zoom in on the 30-minute chart, so I think if you're trading stocks today, I know I'm going a little bit off piece, but in here we were looking at the calendar there, but this is kind of all follow through from the employment report. Here's the rebound we're seeing this morning. This is the 30-minute chart on the Treasury note, and this here is the sell-off in here from the beginning of the year. So the sell-off started from here, okay, from the first trading day of the year. And then really, so the trend starts from here. Now, what's going to be interesting here is if we form a base, if we get some kind of reversal. Now, I'm not saying I'm not overly aggressively long-term bullish on here on treasuries and still think the threat is lower. But if we get some kind of respite, given that, again, I'm going to skip back to the daily chart, given we've had 5 straight down days, the market tried to go lower. Now, already this pattern at the bottom in here, you could say, it's a hammer pattern, which is a positive bullish pattern when it's at the end of a downtrend. So we're a downtrend in here. This could be a short-term positive and aiming the market back higher. And switching back to the 30-minute chart, what I think is going to be critical in here. So here's from the beginning of the year, and this was the very end of 2021, the 31st. Now, if we go and take a look at the trend line that we have off that peak from the very end of last year through these peaks here, and you'll see the market has flirted here. So look, it's a really good trend line. Actually, you could draw, it even touches here actually, but I actually drew it off this peak here, and then it goes and touches here, and then we get the market flirts with it, doesn't manage to really reverse it, goes back down again, and then on Friday and this morning in here, Friday the market bounced up close to the trend line and failed and went lower again. And now look, we've reversed the trend line. Now remember, this is all pre the actual markets being open. Okay, well actually we're cash markets opening up in here on the bond side. So there is, I think, real threat in here for if we take out these peaks in here. So this is on the March futures contract. The high there, let me just make the box a little bigger here. If they got a mini peak in here from Friday at 128.12.5 on the March futures, just there. If it can get above there, then that's kind of signal a little base in here, a little kind of almost like a double bottom pattern. You've already reversed this important trend line. You could even then redraw the trend line out here. So I'm going to see if I can just drag that trend line out of this peak here, of this peak here, if you wanted to redraw it, it's going to come in around the same level if it breaks above that peak. But I think this is the real trend line. This one here, that's the real trend line. Let me see if I can just extend that out. Extend. Okay, there we go. So extend it out. So I've drawn it off this point here. You can see already broken, but I think it takes out that peak there. It will also reverse if we redraw the trend line of this peak here. Then this is all looking more positive for bonds. And I say I'm not aggressively bullish. It's clearly still in a downtrend, even though we're trying to reverse. But you could easily see a correction back up into this area here, which should be higher prices, lower yields, and that will take off some of the negativity, some of the negative pressures that we're seeing on the equity markets. So certainly, if you're trading stocks in here, there's something to keep in mind. Keep an eye on this. Well, let's get back to the calendar. But so in here, the unemployment report kind of mixed in here. Market's not quite sure what to do with it in here. And if we actually dip into this article in here, there's a little article it got from Forex Live. Okay, you can go and find this from Forex Live. Sunday's got underneath education. Friday's NFP should lower expectations for Fed policy. There's a real risk that the markets and the Fed are being too hawkish in their forecast. So there's a little article in here saying that even though inflation is still, there's a lot of inflationary pressures. Clearly, the jobs report from December, even though unemployment is very, very low, it seems to be we're getting to a point of of the fact that some of these pressures in here, these supply side pressures are starting to ease a little bit, and we could see the Fed start to maybe back off a little bit if we do kind of hit and then pause around the high employment. I also read another article over the weekend, more looking at European data, but also looking at the US data. On the inflation side, and saying inflationary pressures could have peaked already. We could have already seen the high in the inflationary pressures. That doesn't mean that the Fed are not going to continue, and central banks globally are not going to continue to look at hiking and increasing interest rates this year. However, it might be that they're not any more hawkish, any more aggressively hawkish than they are right now. Now, we've got rates futures. The futures market is actually saying there's a 70% chance of a Fed rate hike as early as March right now. And Goldman Sachs, I saw an article out this morning saying Goldman Sachs now saying expectations of 4 rate hikes. Now that's a really aggressive rate hiking cycle. 4 rate hikes now in 2022. So it could be that we're kind of the market's getting a little ahead of itself about how hawkish and the Fed are going to be, and how much further these inflationary pressures are going to come through. It could be that as we go into the year, inflationary pressures actually start to subside slightly, and the Fed, even though they're going to clearly be hiking rates here, and maybe not going to continue as hawkish as the market's starting to price in. Okay, so it's something to watch out for going forward, guys. Okay, but again, in here, Forex, I'm also pointing out, on the yield side, just as we looked at in here today, on the bond prices, bonds hitting new. Going back to the chart in here, bonds went to new low prices, bond futures new low prices this morning, and that equates to treasuries going to, if I just make this a bit bigger, we broke out and pushed to new, broke it last week, and then pushing to new higher yields through 1.8%. And we are in, pandemic era, kind of yield levels in here, going back to in here. So this is, if you look back here, this is where we sold off. Okay, through the pandemic, so there's the sell-off from this whole sell-off here is the sell-off through March, as the March 2020, and we're back to March 2020 on pre-pandemic levels, okay, in yields. So maybe the market's done enough for now, and we do get that correction that I just spoke about there, looking at the bond chart, the treasury future chart, and maybe then that's going to give some respite for the sell-off that we're seeing in stocks. Just to run through a few more articles in here. So rate bets, 10 US 10-year yield briefly traded above 1.8. We've already said that in here. The bond market continues to be a global phenomenon with Australian sovereign debt selling off. German 10-year yields close to turning positive. German 10-year yields have been negative yields on German 10-year bonds in here in the pandemic era, and close to going above zero for the first time for over a year or two in here. So all of this, again, reinforcing the views of a more hawkish central banks and high yield territories for bond markets globally. But as I say, for today, we do seem that we're kind of turning a slight corner in here. Oh, here we have. So look, analysts increasing bets with Goldman Sachs, and they now expect 4 rate hikes this year. So there's it there. Omicron hitting China in here, Russian concerns around Ukraine steer, but markets are generally quiet. Equity markets, as we said, lower. Bond markets have been lower and they are rebounding, but so far lower in the aftermath. So stocks fall further as US yield climb unnerves investors. We've already discussed that in here. Wall Street week ahead. Hawkish Feds gives value stocks a second wind. So yeah, so what we are seeing is we're seeing value stocks outperforming their growth counterparts in here. No surprise there, because it's all being driven by higher yield. So that article looking at that, and futures in here. I get this article. Futures muted. Banks extend gains on higher yields. So banks have been the big win. The banking sector has been the big winning sector in here since the beginning of the year. Why is that? Because higher yields is good for the banking year. Higher yields, higher interest rates. It's easier for the banking sector to be profitable in a higher yield and higher interest rate environment. Hence, we're seeing the banking sector do well in here to kick off 2022. Okay, I'm going to revert back to the calendar. We looked at Friday. Let's take a look at this week coming. What we have in here. So for today, it's very, very quiet. And we do get Bostic speaking later today. Now it's going to be interesting to see what comes through. That's at noon Eastern time. These times are all Eastern time. Okay, so at noon we have Bostic speaking. So it's going to be interesting to see the reaction, seeing as we've had now the Fed meeting minutes released. It's going to be interesting. And we've also had that now employment data out of the US. It's going to be interesting to see how the Fed speakers start to react. Is it in line with what the market's starting to price in? Going into the week in here, some more Fed speakers tomorrow, Messer and George. Critically, though, Powell is testifying in front of Congress. That's 10 a.m. tomorrow. That's probably going to be one of the standout events. We don't really have any significant central bank events this week, but that's probably going to be one of the standout events of the week in here. Powell testifying before Congress, 10 a.m. Eastern time on Tuesday. So we're certainly going to be watching out for that. We do have CPI data out of the US, 8:30 Eastern on Wednesday. That's probably the most important piece of data of the week in here globally, and certainly for US markets. CPI data, inflation data, and with all eyes on inflation is going to be super important. So we're certainly going to be watching that. We get the weekly crude oil inventory data also on Wednesday. So watching for that too. Moving on to Thursday in here, we get PPI, nowhere near as important. Initial jobless claims from the US, nowhere near as important as the CPI data, but nevertheless, we will be keeping an eye on that going into Thursday. And then to round off the week in here, actually, I think we have got retail sales from... retail sales from the US is on Friday. Retail sales, I think, industrial production, manufacturing production, that's right, from the UK, and GDP data from the UK on Friday. And then we get retail sales data and also industrial manufacturing production data from the US on Friday. So Tuesday and Wednesday, probably the most important dates to have in your diary, watching out for Powell speaking on Tuesday to Congress, and see if there's any reaction to the employment data, any questions, any Q&A, and then on Wednesday we get the CPI data, but Friday also important, but to a slightly lesser extent with the retail sales data being released out of the US. Okay, we kind of run through the charts mostly on the European, on the bond and equity side. Just a quick note in here of some levels, maybe really just these swing highs, but S&P 500 making a new low. You can't be positive. You'd have to be bearish going into this, but I'm kind of cautiously thinking that we could see a rebound in here today on stock markets. I was looking for it on Friday. We didn't get the rebound, but you didn't really get a sell-off in here on Friday. The market was kind of sideways. The sell-off was very, very late. We get a little sell-off in here on the stock market open, then it kind of stabilized, and it was really right going into the close that we saw a sell-off in here again on the equity indices on Friday, and then this morning we're obviously lower again today. I think if you're short, you have to have a very agile stop in here, because I think this could easily turn around. Short is the way. Clearly, the trend is lower. You can't deny that. In here, trends lower on S&P, and if we look at the Nasdaq, even more so. But I think you have to be very, very careful. We're just off the current lows in here on the Nasdaq. But I think you have to be very, very careful. I think this thing could easily turn around. And as I said before, I think all eyes on the bond market. if the bond market can get above, and I've already said the level in here, 128.12 and a half in here. If we can get above there and hold through the cash market opens in here, I think then the bond markets could be higher and stop indices higher with it. Let's just jump across to the commodity markets and have a quick look at what's going on in there. Here's oil. Now, oil had a really strong day on Thursday, up to close to in here the recent cycle highs. It's just the main over here, just failing from below this peak in here, this impulse peak from November. And the market's setting back slightly on Friday and setting back. So, going into today, I think this is a buy in the dip, opportunity for oil. So zooming in on oil, going to the 30-minute chart. So we do have a little topping pattern in here. I'm kind of concerned that I don't really want to be buying this dip in here at the moment. And if we just zoom across for oil, well, certainly you've got the trend line that comes up through here. I might switch this to a 60-minute chart. So you've got kind of this, then the market's already broken, I think, this more accelerated trend line. And it comes through here. And there, yeah, so look, it's a really good trend line, so you got the, let me get rid of this one. Okay, so you look, so drawing it off the low in here, the low there from, where was this? This is just before Christmas, 20th of December, through this low in here, which is from the beginning of the year, from the 3rd of January. And look, you see we touched it there on the 6th of January, touched it again in here on, I think this is on Friday. Actually, it's on the overnight. This is on the overnight this today. And then look, breaking it now. Now, I think, again, probably wait until the US equity market opens in full to see if we continue lower. So, I mean, you could argue we've broken that there, but I think, just be very careful. If the equity markets turn around again and we see a risk-on scenario come in, if, going back across here onto the bond chart, it's going to make this a bit bigger, actually. But on the bond chart, if bonds can push back higher, then stocks can go higher and oil can go back higher. Bonds in here at the moment actually dipping back lower in here. But I think, it's all eyes on the bond chart in here to trade these other markets. But if I zoom in here, say we have had a break of that longer term trend line that goes back to like Christmas in here. Let me just make that a bit bigger. There we go. So we've just broken that in here this morning. Okay. But potentially looking for a swing on this as well. So, but if we don't get any swing, I think through the cash market opens, then you can stay short. I mean, short is the position right now, but I'm just really wary of this thing swinging. Quick nod to the gold market. Now, we did get a notable sell-off in gold on Thursday. Market kind of held with a little hammer pound on Friday and indecisive this morning. If I go into the 30-minute chart, kind of very hesitant in here, slight uptrend, but it's been choppy and sideways. I mean, I wouldn't be trading this one. I think it's been a bit of a mess as a chart. It's really difficult to trade in here at the moment. For my money, I think I'd rather be short. And we took out, remember we looked at this previously, we took out some important lows in here on, these lows in here and here, and we broke these lines in here. We looked at this previously. So I think, out of choice, I'd be short in here because we've broken this support. And you can see the market's had this rebound and, the last hour in here, the market's been selling off. So I think the threat for me is to the downside on gold as well. So watching out for that. But again, we get a stronger dollar. If bond markets, watching the bond market as well, and this could have an effect on gold. But there has been a bit of a dislocate now between the bond markets and gold and the dollar. So I think it's a tricky one to trade. For me, I wouldn't be touching it right now. Okay, guys, so just going back to the calendar, nothing really of note to watch in here today from the US. We do have 3-month and 6-month bill auctions. They shouldn't have a significant impact on the bond market, okay? We do have those. Bostic is the main focus in here at noon Eastern time, so keep an eye on that. I'm going to wrap us up there. I'm going to wish you all a great trading day. Please do stay safe out there, and I'll be back with you for another bull versus bear webinar tomorrow, Tuesday, 11th of January. Take care. Stay safe.